on power and internet providers. Okay, so we're talking about convertible preferred, and essentially I was saying that we have the liquidation preference right of 1.5 times, means that I have the right to get my money back multiplied by 1.5 times, 3 million. So what happens if we sell this company for 2 million then? 2 million, by the way, is the amount of money I invested. If I sell for 2 million, remember they have the right to be paid 1.5 times my money, which is 3. So I get all the money that we fetch on the sale of the company, the whole 2 million. There is nothing more else. So I get the entire 2 million. So now suppose that that we sell for 4 million. If we sell for 4 million, then first I get my 3 million back. I'm going to exercise my liquidation preference right. So I get my 3 million back, and whatever is left is paid to the founders. If we sell for 8 million, I can choose between getting my money back, which is 3 million, because my money multiplied by 1.5, or 50% of the firm. So if I choose 50% of the firm, I'm going to get 4. So in this case, I'm going to basically to choose to convert. And by choosing to convert, I will essentially getting 4 million, in other words, 50% of the sale of the firm, and not the 3 million of liquidation preference. By the way, because now Microsoft is trying to mess up with my other computer, if you want to speak, please, you need to use the speaker because I can't see you on the other computer. When Microsoft decides that restart is a good moment to start bossing in our machines, it's amazing. Okay. So with liquidation preference, that's what happens. With participation, it's more complicated because we always get our liquidation preference plus our percentage of the equity. So what happens? I always have the right, in this case, to get my money back multiplied by 1 times. And then on top of that, I get whatever is left. So let's say if we sell the company for 8 million, in this case, I have a 1x liquidation, so I have the right to get paid 2 million. So I get 2. There are 6 million left after paying myself the 2. I have 50% of the firm, so I get half of those 6 million. I get another 3. So I get 2 million from my liquidation preference, and I get 3 million from my 50% of the equity. That's why it's called double dip. Well, of course, for a low valuation, well, I get the entire 2 million, nothing special. For 4 million here, I always get 2 million, which is my liquidation preference, plus half of whatever is left, half of the other 2 is another 1. So as you can see, my 50% SVC give me always more than 50% of the firm. The founders 50% always give them less than 50% of the firm. So when founders become too picky about what valuation they get, and they get too picky about the percentage of the equity they are going to get, the VCs put participation there. In other words, give you the valuation you want, but you get in practice less equity than you think. If we sell this company for 1 billion, well, this participation is totally irrelevant. This participation means first someone gets 2 million, and then we share the rest. If the rest is 1 billion, who cares about the first 2 million? So participation is relevant for situations where success is not spectacular or truant success. For situations where we have a spectacular success, then participation doesn't become that relevant. So let's try to look at a more complicated example and try to look at. Oh God, I can't use the other computer. There's nothing I can do. Okay. So there is no way I can see your raising hands and things like those unless I do something completely stupid like don't using these anymore. Let's see if I can manage this somehow. Yeah, I do this, but then I stop watching your faces. There's nothing I can do. Okay, so let's look at a situation where company XYZ is funded with 10 million euros invested by the venture capitalists. Entrepreneurs just invest business plan, no cash. Entrepreneurs get common stock, as it's usually the case. I'm going to look at 4 financing structures. And A, VC receives 50% of common equity. 2, the VC gets a redeemable preference stock for 10 million with a dividend of up to 25% of that and gets 50% of voting rights. In other words, the only thing the VC gets is the right to get their money back plus the dividends as they accrue throughout the time. C, together with B, we have the right to get 50% of whatever is left. That is called the double dip or participation. Or D, you have to choose between getting our money back plus the 25% or to convert into common equity. Basically, D is a choice between B and A. That's what you get in convertible preferred. So let's look at what happens. Let's look at common stock. Nothing special. If the valuation is 10 million, I get 5 million. If valuation is 30 million, I get 15 million. Nothing special. In all other structures, the structures involving preference stock, because of this liquidation preference of 1.25 times, my money back plus a 25% dividend, I'm always getting the value at which we sell the firm unless the firm is sold for more than those 12.5. This is the inflection point, the 12.5. So unless we sell the firm for more than 12.5, we get all the money that is there. So in that structure, for the founders, they will always get nothing. They only start getting paid if you get a valuation in excess of 12.5. While in common stock, the founders get paid even if we don't get our money back. So it's to prevent that from happening, to prevent founders not to be paid, to prevent the founders to be paid even when VCs are not paid, that we never invest in common stock and always put a liquidation preference. So you can see here is founders being rewarded for failure. They put no money and they are still being paid, in this case, 4 million for selling this company for much less than what we paid plus our dividends. So this is what happens here. Until we get to this 12.5 million, founders get nothing because the VCs will exercise the liquidation preference and get their 12.5, there is nothing left. But if you do, let's say, a sale for 15 million, what happens? If you do a sale for 15 million, what happens is we get our 12.5. That's what redemption means. That's what liquidation preference means. And then in that case, the founders will get whatever is left. So here, let's say for these valuations, founders are already getting whatever is left. Now, the stupid thing is, if the only thing we get, is redemption. If the only thing we get is redemption, means whatever value above this 12.5, we only get 12.5. The redemption is this line. Of course, that's not what VCs want. VCs want the upside. And that's why redemption always works in conjunction with double dip or with conversion. Conversion gives me the right to convert my shares in common stock. So if the company is worth 30, what do I prefer to get? My 12.5 million or 50% of the 30, which is 15? Of course, I prefer to convert. So conversion basically is this line here, here, and that.
Professor?
Yeah.
Can I just have one question? So
Sure.
When you're referring to dividends, that percentage is always in relation to what the VC is investing?
Usually, but not necessarily. Dividends declared on preference stock are there or are declared just to add to whatever is going to be paid in case of redemption, in case of exercising the liquidity preference, to guarantee a minimum return. In this case, basically, it's not a complete disaster. I invested 10 million, we sell the company for 16, and I still get 12.5. Okay, I get a 25% premium on top of whatever I invested. Is a way to protect me, and basically, in this case, founders get close to nothing. It's this blue line, sorry. Founders get close to nothing. They get very little money. So the dividend is just to raise the bar a little higher than the amount really invested by the founders. Sorry, by the investors.
Okay.
What is important is to understand how the convertible works. The convertible, for low valuations, we just get whatever money is there. And after we reach that threshold, which is the liquidation value, which is 12.5, we get our liquidation preference, which is 12.5. And above a certain number, in this case, it's going to be 25, we will be better off by converting into common stock than to get our liquidation preference. So as I said, in 30 million, I will certainly prefer to get 50% of the 30 million than my 12.5. So the convertible is like this, and that. By the way, do you guys mind going mute? Otherwise, you get too much noise on the line. Thank you. And what about participation? Participation is clearly not the most popular thing with founders, because in participation is the same, except that when they reach here this 12.5, I still get 50% of whatever is left. So it's this green line. So it's going to be all these, like the others, plus the green line. So graphically for the founder, well, participation, I should have the same. I don't know, I just copied the graphics and it changed the colors. Okay, should have the same colors for the same security. This thing is the participation, is easy to spot, is the one who pays less. So that's why it's easy to spot. And indeed here, the founder for a low valuation gets nothing. And for a close to no low valuation, first we pay the 12.5 and then get whatever is left. Sorry, then get 50% of whatever is left. The vertical difference between these two is the amount of money that has to be paid to the VC. Liquidation preference plus participation, the double dip, ends up being the worst possible situation for the founders. The best situation for the founders is, in case of failure, is the common equity, the red one. Do you mind going mute? In case of failure is common equity. In case of success is for the VCs being so stupid to demand to redeem their securities instead of sharing on the upside. So it would be...
Professor.
Yeah.
So why would founders accept the participation?
Everything can be negotiated, right?
Of course.
Okay. Okay. I tell you, I want participation. You say this company is going to be worth 100 billion, right? I'm investing 100 million, and you just had that reaction. I don't want participation. What have you just told me? Do you mind explaining me what you have just told me? You just gave me very relevant information. Remember, it's all about screening. What have you just said?
I asked you why founders would accept the participation.
No. You said your company is going to be a unicorn. And then you said, I don't want participation. What was the message I got?
That you don't believe it.
Exactly.
That
Why are we discussing peanuts? Why are we discussing a ridiculous 100 million, which is nothing? It's 1% of the 100 billion you just said that the company is worth. Actually, it's not 1%, it's 0.1% of the value. We're discussing peanuts. So how can you be saying this company is going to be a unicorn and simultaneously start discussing peanuts? You will only do that if you don't believe this company is going to be a unicorn. So if you just come to me and say, I don't accept participation, just told me that you don't believe that this company is a unicorn. So it's very simple to understand why people accept this when we are talking about very high valuations. Because if while looking at a tremendous exit, this makes no difference. It's a small vertical difference. In the case of a few million, in the context of billions, this is absolutely nothing. So why shouldn't you accept? The reason is, if you don't believe in this company's success, you're definitely not going to accept this. You see, a big part of the term sheet is to see what people really care about. I told you this, is to see what people really care about. It's a screening mechanism. I know a guy who says, I will never accept participation. It's probably the first thing he tells to VCs, and he's failing to raise money. Because when he puts so much emphasis on the participation, he's basically saying, and it's very likely the case of his company, that company is never going to be a tremendous success. Someone was going to, yeah.
Yes,
Professor?
One question. In practice, is it common that founders have legal or financial advisors when they're negotiating VC terms?
Some have legal advisors. I don't think it's very useful because the problems that we are discussing here are not legal. The problems we are discussing here are basic problems of incentives and problems of economics, really economic problems.
But I mean, even if I believe in my company, there are always things that can happen that will make the company fail, something like COVID, for example. So even if I think I'm going to be a unicorn or my company is going to be a unicorn, I still want to have some security in case it does not become a unicorn. So those term sheets have to be pretty well negotiated. And if I'm not a finance student or legal student or something like this, I can imagine a lot of founders are pretty lost and accept VC terms that are not in their favor.
And
that's a bad thing for the founder. So I could imagine that they're trying to get advisors to negotiate the best possible terms for them.
Sure. And you get the best possible terms from a VC who gives you no value added. That's what LifeX told us. Who's going to give you the best terms? The VC who has little to offer to you. Because the VCs who add a lot of value to the firm, they are going to charge for that value. They have to, right? So what do you prefer? I usually ask this question to the end, but what do you prefer? Bad terms from Sequoia or good terms from no one?
Well, I guess if Sequoia wants to invest in you, you say yes, whatever.
I always take a worse term sheet from the best VC, always. Because the bad VC is going to transform my company in nothing. and the very top VC is going to make me, to transform me in a very valuable firm. So do I care about 5% more or less, or do I care about a billion more or less? I prefer to discuss the billion than the percentage.
But then it's not a common practice that VCs offer term sheets that are like really not at all in favor of the founders. That's just not a thing. So Sequoia would never offer term sheets to potential targets with like super terrible term sheets for the founders.
I have a slide with that, with a joke on that, on my slides. I have one on that. Come on, if the term sheet is terrible to the founder, what is the founder going to do?
If he really wants the money, or if he really wants the VC because they have a good reputation, maybe he accepts anyway.
Sorry, if the terms are bad, the founder will lose interest.
So I have to find a trade-off as a VC.
If I believe that the founder is important as a VC, will I want a demotivated founder?
So there's always like a certain point that the VC is trying to achieve, that the terms are good for the VC, but not too bad for the founder, that the founder will not lose any interest. So the terms are already like kind of set in stone already before the negotiations.
No, they are not, but you can negotiate lots of different things. And VCs know more about these and will come up with solutions for themselves. Remember, I told you, in Europe, the average internal rate of return for venture capital is disastrously low, which means that if whatever VCs are doing is to give founders very good terms, because the returns they are getting are not enough. So it's not the terms that really matter. We are going to be very pressured on time. So let's try to move on. So stage financing. What I told you, there are two reasons why we do stage financing, but because we do financing in stages, we are going to need some kind of protections. Two reasons for stage financing. One, the founders themselves want stage financing. If we know that with time our reputation will go up, our credibility will go up because we're going to prove more and more and more, that means that valuation will go up in time. So instead of taking too much money now at a low valuation, I prefer as a founder to take little money now at a low valuation and then raise more money later at a higher valuation. VCs know that it's better to be in better control of the investment. So a very academic example, and by the way, most of the people in this course are finance guys, and so therefore we love real options. So a simple example with options. So suppose that there is a project with 70% probability of developing a new technology, and we need 6 million to develop that technology. If the technology works out, like your tetroid, if you finally get the tetroid, then we have to commercialize that technology. And we're going to need to invest 5 million more for commercialization, and we expect a 60% probability of success. If I don't do staging, I'm going to give you 11 million right now, and you get a 42% probability of success, 70% on the first phase, 60% on the second one. So there is a 42% probability of success, okay? And 58% of failure. So if my cost of capital is 30%, and sorry, it seems that you're on the slides on Moodle, this 2 is in the wrong place. This is squared, of course. I get an expected NPV of 7.6. If I do staging, what I'm going to do, I'm going to give you 6 million for the technological proof of concept, which has a 30% probability of failure. And then if you achieve that milestone, and milestones are going to be pretty much important in this staging game. If you achieve that milestone, then I'm going to make a second investment of 5 million. Okay? And which then has 60% probability of success. So the overall value here raises to almost 10 million. So this is the value, the pre-money valuation that we have to split. And here, this is the pre-money valuation that we have to split goes up. Why? Because I can tie this 5 million to the milestone of having a working prototype in a year. So based upon this, we know that we have more control over the investment. Essentially, the second part is what you in some courses have called options to expand, is a real option. So all the theory in venture capital is also about real options. Here, one point I want to make is we prefer to do staging, to do subsequent rounds, to have better control over the investment, and that actually increases value on the venture for everybody as a whole. What if people fail to meet the milestones? Well, in that case, we have a problem. And the problem we're going to have is we're going to lose value. That means that next round, we're going to issue shares at a lower valuation than on the previous round. So if there are shares issued at a lower valuation, I, as an investor, need protection for that. And more than that, more than protection, this is a mechanism through which I'm going to effectively change the valuation given on the first round. The first round valuation was given under the assumption that some milestone is going to be met. So if that milestone wasn't met, then that valuation was wrong, and we're going to correct the valuation through anti-dilution provisions. The other thing we need to protect on future rounds is, in the case of success, we need to keep investing on the fund. We want to protect our percentage of the equity. So typically, VCs have what we call preemption rights. We always put on the term sheet, we want preemption rights. If we have 40% of the equity, we want to have the right to buy 40% of every new equity that is sold by this firm. So in the case of success, we use our preemption rights. We want to have our equity percentage not diluted. But in case of failure, we want more shares. And the two forms of ratchets here are the full ratchet and weighted average. This is easier to understand with an example. On the first round, we have 5,000 shares outstanding, of which 2,000 were purchased by the VC at a price of €1 per share. So effectively, the VCs invested €2,000 and own 40% of the firm, 2,000 out of 5,000 shares. The other 3,000 are owned by the usual crowd, founders, angels, employees, etc. Okay? So we had a post-money valuation of 5,000 of the first round. 5,000 shares times 1. Things don't go well, and you do a down round. In other words, we need to do a new round at a lower valuation. We're going to print 2,000 new shares at the price of 50 cents. A new VC comes up with the money. So now we're going to have 7,000 shares. The original 5,000 plus 2,000 new shares at the price of 50 cents. So basically, we're just raising €1,000. Without any protection, this VC, without any protection, and without this VC exercising preemption rights, this VC could have exercised the right to buy 40% of these 2,000 shares because they have 40% of the company. But ignoring preemption rights now, this VC will go down to 28.6% of the firm. Okay? If the VC has full ratchet protection, what happens? Under full ratchet, the average price of all my shares must become identical to the price of this round. So I have 2,000 shares at the price of 1. I need to get 2,000 shares for free for my average price to become 50 cents. So in this case, I would get 2,000 new shares for free. So the total number of shares in the company will grow to 9,000. The 5,000 original ones, the 2,000 that the other VC paid for at 50 cents, and the 2,000 I'm going to get for free. This effectively increases my percentage of the firm to 44.4 if I do not exercise the full ratchet. So effectively, I'm bringing the valuation of the previous rounds to half of what it was. I'm going to pay 50 cents for my shares exposed. So founders get very excited about valuation. Sometimes they impose very high valuation on VC, especially in exciting times like this. And then they forget the impact of anti-dilution, because in a moment of boom like this, we insist on a very high valuation. When the economy crashes, we are going to do a very negative round. Actually, one of the case studies we're going to discuss is like that. We're going to do a down round. And then all the anti-dilution clauses trigger, and suddenly the founders get a lot of dilution because of that. So for the people who get obsessed with valuations, I always tell them the first round valuation is not much relevant. It's the second one that matters. Because if you don't meet your milestones, the second round will be a down round, and then the anti-dilution clauses are going to kick in, and then a lot of dilution happens. In practice, you don't get new shares. What happens? Usually the term sheet says, and all the contracts then says, that you can convert your 2,000 preference shares into ordinary shares, 1-to-1. In this case, what would have happened is your 2,000 original shares will need to convert into 4,000 ordinary shares. So at the time we sell the firm, before we're doing any calculation, you would convert your preference shares into ordinary shares on a 2-to-0 ratio. In other words, for 2-to-1 ratio. In other words, for every share you own, you'll get 2 ordinary shares. So typically it works with conversion ratios, not with actual printing of new shares. So those new shares are only printed at the end when we sell the firm, if you choose to convert. And therefore it's the conversion ratio that changes. For practical purposes, it's like this I just said. You get 2,000 new shares for free. Under weighted average, how is that going to happen? I purchase some shares at price of 1, and I'm going to get some shares at the price of 50 cents. And so what is the average price of the 2 rounds? The weight used to compute it, the weighted average price, is the money. So what happens? On the first round, 2,000 shares were sold at the price of 1. So this is it. 2,000 euros were raised at the price of 1. And then on the second round, 1,000 euros was raised at the price of 50 cents. So the weight on the weighted average is the money. So the weighted average price is going to be 0.83 cents. So 83 cents, sorry. And then the issue is how many shares should I get for free to bring my average price to this one? And here, solving this very complicated equation, I need 400 new shares to bring my weighted average price to the same as the weighted average price of the 2 rounds. In this case, I will get 400 new shares, not as bad as the 2,000 new shares I will get there. And therefore, I'm going to get 32.4% of the firm, not the 44.4 you saw there. So for founders, weighted average is always worse than, is always better than full ratchet for the founders. For VCs, we prefer full ratchet. And if we do very inflated valuations, then it's going to be a tremendous demand to put full ratchet there. And if the founders start arguing, oh, but this company is going to be the next Facebook. If this company is going to be the next Facebook, who cares about anti-dilution? Every time we're going to do a round, we're going to multiply the valuation by 10 or 50 or 100 or whatever, right? So who cares about a down rounds when we're talking about the next Facebook? And we saw companies like WeWork who did a stupidly, absurdly, a very high price round, and now doing a down round and with anti-dilution clauses triggering, diluting significantly Mr. Neumann, the founder. In case you haven't noticed, WeWork is trying to go public now through a SPAC, reverse merger, not through an IPO as before, at a small fraction of the valuation they expected for their previous IPO. So it's one of those hype companies who has come through a significant down round. We had a lot of talks about options, etc. What is relevant here is the vesting. What is the meaning of vesting? When you get your shares as founders or employees, you don't get them really unless we have worked to earn them. More clear with an example. Actually, the example here is almost standard for the East Coast and Europe, but it's exactly the ones we have in both term sheets on the case studies. Founders. So let's suppose that you are entitled to 4 million shares, founders. I can put a clause like this: founders' shares vest 25% on closing, with remainder vesting linearly on a monthly basis during 36 months. What this means? Means that you get 25% of our 4 million shares immediately when we close the deal. So you get 1 million shares, not 4 million. What about the other 3 million? Well, divide it by 36, and every month you get 1/36 of that until you get all the shares that have been promised you. This, of course, has a tremendous implication. Means that when we start, the founders don't really own all the shares that have been allocated to them. They are on escrow. And actually, even with 30% or 40%, I have the majority of the vote because the founders don't get all the shares that are allocated to them. What happens if they leave the firm? Usually, if you leave the firm here, let's say after 24 months, you lose an entire year of shares. In this case, you will lose a significant portion of those shares. You lose all of that. What if we fire you? Well, the term sheet usually specifies what happens in case of founder termination. This is there to tie the founder to the venture. It's also what we call sweat equity. You don't get equity for presenting a business plan. You may get equity, that's this 25%, for presenting a business idea, for bringing in intellectual property, for bringing in a concept, whatever. But the rest comes from execution. If you don't execute, you are fired and you don't get all of the rest. That's the idea. So VCs want to pay for execution only, not for business plans. For employees, it's usually stricter than that. For employees, usually the idea is you have a longer vesting period, in this case 4 years, and on the first year, we don't give you nothing. Unless you stay in the company for exactly 1 year and 1 day. If you stay for 1 year and 1 day, we give you your first year's shares. But if you leave the day before that, you get nothing. That's the cliff. Actually, there's a lot of mobility when that year moves. Some people are not very happy. They wait until that year to finish to get at least a quarter of their shares and leave. And then vest linearly. They need to work to earn their equity. It's called golden handcuffs, but also sweat equity. You need to sweat. You need to sweat to really earn them. There are all types of covenants. Positive covenants are things that the company is obliged to do, like, well, this is appoint these people to the board, annual accounts subject to an to external audit and things like those. And negative covenants, like things companies not allowed to do. You cannot make new investments without VC's approval. You cannot raise new finance without VC's approval or without a supermajority of VCs or whatever. So these are typical things that we see on the governance side of the term sheet. We'll see these three examples. Works better than here. What is really important, in my opinion, are the exit route covenants. First, as I said, right of first refusal. If someone wants to sell equity, first has to offer to the others. Founders want to sell, first need to offer those shares to the investors. And vice versa. Sometimes founders want to have the right of first refusal on the VC's shares, but if founders can afford to buy back their company, that probably means the company is not worth much, right? Liquidation clause is already talked about. In event of liquidity, how much money is paid first to the VCs, or VCs may have the right to choose between getting their liquidation preference or convert into ordinary equity, whatever. That must be there on the term sheet. And then two important ones, the drag along and the tag along. Drag along is something that usually VCs insist on. What's the idea? If I have an offer to buy 100% of the company, I, as a VC, need to have the right to negotiate the full sale of the company and force the other shareholders to sell with me. So I have the right to drag the founders and the employees with me. That's drag me along clause. Basically, I will have the right to negotiate the sale and drag everybody with me. Otherwise, I may be stuck in a company forever. And in the venture capital business model, we need to sell to liquidate the investment and pay the money back to the LPs. So drag along is very important for the VCs. The tag along. Sometimes clever founders ask to have the right to be tagged along. In other words, if I, as a VC, own 60% of the firm and the corporation offers to buy my 60%, I can sell the control of the firm and transform, for all practical purposes, the founders into mere employees of that big corporation. And the founders may not like that, because throughout the time, basically the corporation absorbs whatever is on that firm and empties the value they have on their startup. So a clever founder will demand to have a tag-along clause saying, in case you investors sell your stake on the firm, I demand that you give me the right to be tagged along. In other words, you give me as founder the right to sell together with you. And this way, opening an exit for the founders as well, to avoid them being trapped as mere employees of a big corporation. Board of directors and everything associated with the governance. Board of directors, where investors have veto power and kind of information that needs to be disclosed. I usually say governance here is as complicated in the public as in the public listed firm, because here typically founders have more information, and so we need to have clauses in terms of the corporate governance that protect the other investors from wrong kind of actions taken by the founders / managers. So essentially, this means that we're going to have a board of directors with non-executive directors. Typically, the majority of the board will be controlled one way or the other by the venture capitalists, even if they don't have the majority of the equity. They are not going to be there on a daily basis. They go to the board once a month. That's when the board typically meets. Usually 11 times a year because nothing happens in August. But we want the full board to approve all critical decisions. And if the investors have majority, problem solved. If investors don't have majority, then probably the investors are going to demand that they have special veto rights on critical decisions on the firm. And then, as I usually say, the difficulty is the first term sheet. It's very difficult to get the first term sheet, but once people get the first term sheet, others appear. It's usually the way it works. Like Facebook, no one wanted to invest on Facebook. Then suddenly Axel invested, and then lots of VCs wanted to invest on Facebook. But until the Axel term sheet, which by the way Zuckerberg accepted, no one wanted to invest. Facebook was passed by all the big names in Silicon Valley until you got Axel. And it's still like that today. Companies have a very difficult time trying to get their first term sheet. But once they get the first term sheet, then it becomes easier to get others. Or not. If the company is a disaster, you may have found a VC who doesn't know what he or she was doing, and then you only get a term sheet. But the experience shows that the first term sheet is a difficult one. Once the first one is around, people have an easier time. And then, in the end, remember one thing. It's what I was saying before. Don't get too fixated on the terms. Always think about the trade-off between percentage of the pie and size of the pie. It's always better to have a smaller size of a much bigger pie than a big percentage of a very small pie. So the value added from the investor is usually a lot more relevant than the terms. Actually, on the document I gave you, which in my opinion is one of the best written documents in entrepreneurial finance, Some Thoughts on Business Plans, which is on your Moodle by Will Solomon. He says, from whom you raise the money is a lot more important than the terms. A lot more. Bad entrepreneurs get obsessed with the terms and usually pick up the term sheet with the best terms, and then they pay a hefty price on that. We are a bit late, but questions on this? Do you also have a blackout?
So, Professor, could you repeat the reading you just mentioned?
Some Thoughts on Business Plans is on your Moodle. Is together with the case studies by Bill Solomon. He always says, from whom you raise the money is more important than the terms. And I agree. I agree. So let's do the following. Let's get back at 7:15, and then we're going to discuss the trendsetter case, okay? Thank you.